How did quantitative easing affect the Eurozone crisis? Imagine a time when the economy of a whole continent was struggling to stay afloat. That was the Eurozone during the crisis years. The European Central Bank had to find new ways to help. One of those ways was called quantitative easing. But what exactly is that? Well, it's a fancy term for the central bank buying large amounts of government and corporate bonds. This action puts more money into the financial system. The goal was to make borrowing cheaper, so banks and businesses could spend and invest more. During the Eurozone crisis, countries like Greece, Spain, and Italy faced huge debt problems. Their borrowing costs were sky-high, making it hard to pay off debts or fund growth. The European Central Bank started buying bonds in early 2015, about 60 billion euros worth each month. This included bonds from countries in the euro area and corporate bonds. The idea was to lower long-term interest rates and stabilize the markets. It helped reduce the yields on government bonds, making it easier for countries to manage their debts. Quantitative easing also helped calm the financial markets. Before this, there was a lot of worry about whether countries could pay their debts. The bond purchases made investors more confident, easing some of the tension. It also improved liquidity, meaning banks had more money to lend. This encouraged private companies and consumers to spend more, which supported economic growth. But the effects weren't perfect. Inflation stayed below the target level of close to but below 2% for a long time. Growth was slow in many countries, and the boost from QE was limited in the short term. Some experts say it helped avoid a deeper recession, but it didn't fix everything. There were also risks. Buying so many bonds increased the interdependence between monetary and fiscal policies. It made some worry about the ECB's balance sheet growing too large. It also pushed banks to take more risks because of the low-interest environment, which could threaten financial stability. Overall, quantitative easing was a major shift in how the European Central Bank responded to the crisis. It was a tool used to keep the euro intact and prevent the crisis from worsening. It helped lower borrowing costs, stabilize markets, and support some recovery, but it also showed that monetary policy alone can't solve all economic problems. It was a key moment in modern European history, highlighting the limits and possibilities of central bank actions during tough times.